to the Wells Fargo Securities Monthly Economic Outlook. I'm your host, Charlie Dougherty, and with me is Wells Fargo Securities Chief Economist, Jay Bryson. So Jay, the past few months have been very turbulent and there still seems to be a lot of uncertainty heading into the second half of the year. So let's start with a two-part question. First, what does our short-term outlook look like? And second, we just extended our forecast into 2022. What type of trajectory do we think the economy is going to take over the next few years?
Right, so let's look at some recent history. If you look at the second quarter, between the first quarter and the second quarter, real GDP went down 9% between those two quarters. And so if you annualize that, that's over 30%, it's 32%. That's just as a collapse. But it looks like the third quarter is going to be almost as strong. It looks like we're going to bounce back about 25% at an annualized pace in the third quarter. And as we look into the fourth quarter and look into next year, we see positive growth. Now, that's based on the assumption that the economy just doesn't completely lock down again like it did back in March and April. And, none of us really know what's going to happen here with the evolution of the pandemic. We do believe governors are going to be under tremendous pressure not to lock down like they did before. But we'll see how things play out there. As we look into 2021, if we look at the overall growth rate for that year, we're looking at 4.5%, which is a very, very strong number. But keep in mind, we fell into a very deep hole in the first and second quarter of this year. So when you look at the level of GDP or the size of the economy, we don't think we'll be back to where we were at the end of 2019, which was the peak. We don't think we'll be back to there until the end of next year. So it takes us almost 2 years to dig out of this hole. And then, as we go into 2022, and that's obviously a long way out, we look for, positive growth on the order of, let's call it 2.5% or so. So, again, assuming that the economy doesn't completely lock down again, we look for positive growth in the next few years. So Charlie, let's drill down here a little bit, and is there any part of the economy right now that's overly weak, or any part of the economy that's really strong right now?
Yeah, so there are a few parts of the economy that have been fairly resilient over the past few months and are actually bouncing back pretty quickly. So consumer spending on goods that are meant to help us adapt to this new normal of social distancing, that's a good example of something that's bounced back pretty quickly. And so that's consumer spending at grocery stores, at car dealerships, for sporting goods, home furnishings, things like that. So that level of spending is actually above the level that we saw in February. Now, the flip side of that is services spending, especially close contact services, such as going to eat at a restaurant, or going to a doctor's office, or air travel. That services spending still remains fairly weak. So services spending is actually a much bigger slice of the pie than goods spending. So overall total consumer spending is still off by about 5%, but that spending on consumer durable goods is a real big bright spot. Now, related to that, we have record low mortgage rates that have really fueled a strong bounce back in the housing market, both in terms of sales and new residential construction. So add on top of that, we're seeing a lot of folks leaving the city in order to trade up for more space in the suburbs so they can build out their home offices or fitness studios. And we've got a really strong housing market. So the Fed's probably very pleased to see that low interest rates are having a positive impact on the housing market and broader economy. But Jay, the Fed recently announced that they're shifting how they're going to conduct monetary policy. So what does that mean in practice, and what does that mean for our forecast?
Yeah, so what's the Fed doing? So up until now, they've been targeting an inflation rate of roughly 2%. And frankly, they haven't done a very good job of hitting that in, say, the last 10 years or so. Every once in a while, we'll get up there. But, in general, if you look over the last 10 years, we've been below 2%. And so what they're moving to is they want to hit 2% on some average period of time. And that doesn't sound like that big of a deal. But what it means is what they're hoping to do is have inflation at some points. If we're undershooting it, then they're happy with it overshooting for a period of time. Now, that's not to say we're going back to 1979 sorts of inflation, but what it does mean is the Fed is willing to tolerate higher inflation. So what it means in practice is they're going to keep rates low for a considerable period of time. And although they're probably not going to cut into negative territory, if we continue to struggle to hit 2%, they will probably continue to buy more government bonds, more quantitative easing. And, the practical implications of that is that keeps the long end of the curve very, very low as well. So, in general, we will remain in a very low interest rate environment for a considerable period of time. So Charlie, that's kind of monetary policy. What about fiscal policy? We don't have any assumptions in our outlook about the election in November, but right now Congress is talking about another fiscal stimulus sort of package. What happens if they don't do anything in terms of more fiscal policy? Is that a threat to the overall economic recovery that we're looking at here?
Right. So as you mentioned, another fiscal relief package, although possible, it's not looking probable at this point. So we don't have that as part of our forecast. And the reason is, there's just too much distance right now between what the Democrats and Republicans are viewing as an appropriately sized package. So we don't have that as part of our forecast. That being said, if we were to see a relief bill, that would bring some upside to our outlook. Now, remember that strength in consumer spending that we were talking about earlier, a lot of that was derived from those direct stimulus checks and expanded unemployment insurance benefits. So if we were to get another round of fiscal relief, that would certainly, I think, help the economy grow a little bit quicker. But as I said, we don't think that's in the cards at this point. So whatever the case, it's going to be an interesting next few months. So Jay, thanks for joining us. And from all of us here at Wells Fargo Securities, thank you for tuning in. Please join us again next month for our monthly economic outlook.